Hi everyone, welcome to episode 5 of this Learn on the Go series. And today's inquisition is from a post that I came across on LinkedIn. So this one was by Ishmohit. If you don't know, Ishmohit is a co-founder at SOIC, the School of Intrinsic Compounding. They give out really good stuff. And there was this one post, let me just quickly find it. Yes, this one. One of the ways through which we source ideas, and they've given it's kind of a 7-step process that they've put across, and I'm really interested in the first two. So look at this. Look for stocks which expanded their fixed assets quite heavily in the past. Boleto, they have put in a lot more money on increasing their capex, so in terms of increasing their fixed assets. And secondly, and this is probably a consequence of it, is that the margins are down due to higher depreciation and interest costs, and there might be the possibility of a bad cycle as well. So there's more to it, but I think this is what I want to really focus on. And you come to look at it, it's more like a company which is trying to prepare itself for the future. So I call them kind of future ready kind of companies. And think of it like a farmer, who's using the time to till his land. He's sowing the seeds, making sure that everything is right. So when the rain comes in, he's a lot more prepared, and probably he can make a nice harvest out of it. So this one is a bit like that. And that's what we're going to try and examine and learn in today's video. All right, so let's do our favorite activity. Let's now go to Screener, create new screen. And so we have a couple of criteria, right? The first one is on the fixed assets. So we can take gross block, we can take net block as well, but I'm just going in for gross block. And what we want is that the gross block of this current year should be at least 40% more than the gross block of the previous year. So this is criteria number one. And the second one is on depreciation and the interest cost. This has to take in a massive chunk of the EBITDA. So let's say 50% or more of the operating profit of the company, right? So this is our criteria. I think this should be sufficient. Let's run the query. Yeah, and we get about 79 results. Let me sort it by the market cap. And as you can see here, a lot of it is small caps, micro caps actually. Very few of them are large caps, just a few mid caps as well. And we'll try and look at a couple of companies from here. Let's look at this one, Craftsman Automation, which is a Coimbatore-based company. It's largely into three things. Firstly, there's automotive powertrain. And what do we mean by a powertrain? Well, very simply, it refers to a set of components that generate power inside a vehicle, something that makes the vehicle move. So as you can see here, there are cylinders, transmission parts, etc. Craftsman's second business is all these aluminium products that it designs and manufactures. And very specifically, I want you to remember this pie chart. Actually, both these pie charts, I'll come back to this in just a minute. And the third and final segment is their industrial and engineering business. It's a relatively small one, just around 15% of the revenue. And it's mostly this storage solution business. Okay, let's go back to that pie chart. And as it stands on the aluminium side, Craftsman does 35% of their revenue. DR Axion has 38%, while Sunbeam does 27% of sales. This is not always the case. Let me show you the profit and loss statement. Let's go to product segment. And notice here that, while the powertrain segment has had a steady increase 1500 to 1800, notice the aluminium products, which were just 935 crores way back in FY23, and that has now gone up to 3000 plus crores. So that's been the engine of growth for this company. And this is basically those acquisitions of DR Axion and Sunbeam Lighting, which have really helped in upping this particular number. So if any of you are looking at Craftsman Automation, then you should definitely read up more about Sunbeam Lighting and DR Axion. How does this connect to our story? Let's go back to Screener. Let's go to the balance sheet, and the thing you might notice is a sharp increase in the fixed assets. So it was 1500 for a pretty long time, and then in FY23, the first kind of attempts were made at increasing the scale, and that has been consistently increasing. So in the last 3 years, the fixed assets have almost doubled. So what was just 2000 crores in March of 2022 is now almost double at 3700 in terms of plant and machinery. Now, obviously, one of the consequences of this is going to be an increase in the depreciation. Let me close this. Yeah, so look at depreciation. So what was somewhere around the 200 crore mark is now up to 347 crores for FY25, and this is expected to go even further. Another area which has gone up is the interest cost. And obviously, the company had to borrow debt to finance all these acquisitions. In fact, the debt itself, you can see it was somewhere around the 800 crore mark, and it's now at 2,358. So almost 2,400 crores. But what happens because of all this is that your profit margin starts taking a hit, the net profit definitely. So just ignore this part here, this operating profit margin for the moment. But if you just look from a standalone perspective, what was 340 odd crores interest plus depreciation in FY23 is already more than 550 crores. So there's been a jump of what, about 60%, 65% in terms of depreciation and interest costs alone. This, of course, should not come as a surprise. Even the management knows this, and just picked up something that their chairman and managing director, Mr. Srinivasan, said, and he very clearly defined it in his comments, saying that, we're going to have a few quarters which will not be giving the required results, the desired results that his investors want, the shareholders want. But the way he's kind of justified this entire transition, as he likes to call it, is that he wants now Craftsman, or he feels that Craftsman Automation is at a stage where they are currently very subscale and they will have to grow their business. In fact, their ambition is to become one of the top 5 suppliers in the world, and for which they've done all this capex investments. They've put a lot of strain in their balance sheet, but this is transitionary in nature according to them. So that's really what I mean by being future ready. That is creating certain growth assets which can help you become a much larger company in the future. And let's continue with Craftsman Automation for some more time. Let's look at where they are from a numbers perspective. Let me mildly touch upon the projections for this coming year, and this is the management's guidance. They're targeting a top line of 70 billion. So this is 7,000 crores. It seems possible. They did 5,700 in FY25. So this is just a 23% increase. So 7,000 crores does seem possible. The EBITDA estimate is 1,100 crores. The EBIT is 650 to 700, let's say 700, which basically means the management assumes a depreciation of anywhere from 400 to 450 crores. So EBITDA minus the EBIT is basically the depreciation and amortization number that's there. So simple mathematics. So it's going to be somewhere around 400 to 450 crores. All right, so let's do the math now. So FY26 is what we're trying to project here. So 7,000 crores is the expected sales of the company. The management has said 1,100 crores as the operating profit. So that comes to 15.7% in terms of a blended EBITDA margin, which seems possible. So we'll go with that. So 1,100 is the operating profit. Depreciation, we are already saying it's going to be around 450 odd crores, or 400 crores. So that brings the EBIT to 700. We're still going with the management guidance. And now let's actually look at the interest part. So let's look at the quarterly data and see the interest is already picking up to almost 70 crores per quarter. So let's keep it at 280, and 700 minus 280 gives us 420 crores as the profit before tax. Let's knock off taxation. Let's keep the tax rate at, let's say, 25%. think I need the calculator very quickly. So 420, and we are knocking off 25%. So that gives us 315. So 315 crores is what is my estimate of, or whatever the number says, is the estimate for the net profits, which is a fairly big jump, right? It's from 200 odd crores, which was in FY25. We are now looking at around 315 crores, which is a jump of about 50% in terms of PAT. But as you all know, this is just one half of the equation. We still have to look at the valuations. So let's do that as well. Okay, in terms of market cap, Craftsman Automation is at 16,400 at the moment. This is as of 29th of August when I'm recording this video. So let's do the calculation quickly. So we have 16,442 divided by 315 is what we projected for FY26 as the PAT. And this gives us a forward P ratio, an FY26 forward P ratio of 52.2, which I think is fairly expensive. An entry point of 52 is on the higher side. But if you have a different thought process, a different point of view, then do let me know in the comment section. That said, the objective of this video is not to do the financials. It's more to find growth companies, companies which are future ready. And the idea is very simple, that once, this entire thing stabilizes, wherein they are adding more capacities, there's going to be a time before utilization comes up to pace, which means the operating margins of the company would be a bit lower. Plus, there's going to be depreciation pressure. There's going to be interest cost pressure. So once everything stabilizes, then these companies are in a better position to capture higher market share, which is going to lead to more sales and therefore more profits, better economies of scale, etc. And over the moderate term, these companies can profit from all this wonderful activity that they are doing right now. At least that's the theory of it. You'll have to do a bit more research on this. Please do not take anything I say at face value. I have this habit of being wrong. So please do some more work and do it more as an exercise, because the more you do this, I think it will become a lot easier for you to identify these patterns. And this will obviously lead to you identifying more multi-baggers in the future. Okay, let's go back to our query and see if we can find something that represents a bad cycle. Okay, how about this one? Greenlam Industries. It's a company that's into laminates, decorative veneers, and allied products. In fact, it is amongst the top 3 companies globally when it comes to laminates. It's a big company, and let's go down to the balance sheet. Yeah, and see this. Look at the fixed assets. So it was 400, maybe just getting into 500. And see what's happened in the last 2 years. So from 500, this has jumped to 900 and then 1700 crores. Let's look at the breakdown and look at the plant and machinery from 500 to 1400. So it's a 3x jump that this company has actioned over the last 2 years. It'll be very interesting for you to read up why they went with this massive transformation exercise. But on a more financial basis, obviously this would have led to an increase in the depreciation. So see, from 50s, it's now almost more than double actually. It's 114 crores as of FY25. Even the interest cost has jumped up. It's now 65 as of March 2025 and it's now 78. So obviously the quarterly interest cost is like really bumping up. See, from 16 to 20 to 26. So it's going up by 4 to 5 crores every quarter. In terms of net profits, from positive territory, they have actually gone down to 13, 1 and now negative 16. And in terms of EBITDA margin, what was a consistent 11, 12, 13% have now broken down into single digits, and last quarter it was just 7%. Of course, it's not a straight through reason that things have been bad, so it's come down to 7%. There was actually an exchange loss which the company had to book, I think was some 18 crores or something. And this was largely on account of their plywood business and the Euro INR rate, which was like, I think it was 92 rupees 92 Indian rupees per euro. This has gone up to like 100 rupees. So that led to this notional foreign exchange loss, which tipped the OPM from double digits to 7%. So the company has spoken about it in their transcript as well. Again, I don't want to get too much into the financials, but in the case of Greenlam, a lot of investments have gone in over the past 2 years. Capex of over 1400 crores. Product lines have been increased from 4 to 6. The number of plants have also gone up, and employees have almost doubled from 5,000 to 9,000. The same was summarized by their MD and CEO, Saurabh Mittal, in Greenlam's latest earnings call. And certain points to note here include the completion of most capex activity for the next 3-4 years. So hopefully the free cash flows will be on the higher side. The distribution has also expanded, and the TAM, that is the total addressable market, is up 4 times, largely thanks to plywood, which the company estimates to be a 30,000 crore market. So different companies have their own reasons for doing or not doing anything, but hopefully the company that you are invested in is actually spending efforts. The management there is competent enough to understand what the growth drivers are and is investing in making the company more future ready. At least that's the hope and prayer that we have. And I hope today's video was helpful enough in understanding how to identify such companies, the use of the gross block, the fixed assets of the company is one way of doing it. And I'll be coming up with more such lessons from time to time. And if you have any questions, please feel free to post them in the comments box below. All right, that's it for today, and I'll see you next week.